Hi, this is your instructor, Craig Pence, and in this video we'll be examining the way that partners can divide profits and losses among themselves in a partnership. The same concepts apply here to the members of a limited liability company, an LLC. In our example here from the module, we have two partners, A and B, and the partners have agreed in their partnership agreement to divide profits and losses as follows. Partner A is to receive a salary allowance of $10,000, but B receives no salary allowance. The partners then receive an interest allowance equal to 10% of their average capital balances. Salary allowances are a way to compensate one partner who spends more time running the operation or who has more expertise. An interest allowance is a way to compensate a partner who might have more invested in the business than another partner does. After the allowances are taken care of, the partners agree to share the remaining profits or losses in the ratio of 3-to-1. The way to determine the percentage that should go to each partner when you have a ratio like this is to just add the numbers in the ratio together. In this case, 3 plus 1 equals 4. And then give 3/4 to the first partner and 1/4 to the second partner. In that way you'll be dividing everything up in the ratio of 3-to-1. Let's look at the first example that's given here in the module. We have income of $70,000. How will this income be divided between the two partners? According to their agreement, partner A receives a $10,000 salary allowance. So we give $10,000 off the top to partner A. B does not receive a salary allowance. Then the partners are given a 10% interest allowance on their average capital balances. This is not interest expense recorded for the company. It's simply a way to determine how the profit is going to be divided up. So if A has an average capital balance of $200,000, then A will receive 10% of that, $20,000 in distribution. If B's is $300,000, then B will receive 10% of that, $30,000, as an allowance. So we've distributed now another $50,000 of the $70,000 in profits, and the remainder is $10,000. Remaining profits and losses are to be divided up in the 3-to-1 profit and loss sharing ratio. And as we know, that equates to 3/4 for partner A and 1/4 for partner B. So 3/4 of 10,000 is 7,500, and we'll give that to partner A, and then 1/4 is 2,500, and that goes to partner B. When we total it all up, A receives 37,500 of the profit, and B receives 32,500. This may be a fair distribution of the profits if A spends more time operating the business and contributes more to it that way than B does. B is being compensated for the larger investment in the company through the interest allowance. Let's look at the second example here. And in this case we have income of $30,000. The $30,000 will be divided up in the same way that our $70,000 was before. We'll allow for a $10,000 salary allowance to partner A, and then we'll give each partner the 10% on average capital balances, and that's $20,000 for partner A and $30,000 for partner B. So again, we've distributed $60,000. However, we only had $30,000 in profit, so the remainder is a negative $30,000. What do we do with the negative $30,000 remainder? Well, it's divided between the partners in the same P&L sharing ratio, 3-to-1. And 3/4 of the negative $30,000 means that partner A will be charged with 22,500 of that negative remainder, and partner B receives only 7,500 of the negative remainder. So adding everything up, partner B receives 22,500 of the 30,000 in profits, and partner A only receives 7,500. Now this may be fair in the sense that partner A spends more time running the business and has more expertise than partner B does. If the business doesn't do well, it may be more partner A's fault than partner B's fault. And this will give partner A an incentive to do a very good job running the business. On the other hand, if the low income figure is beyond partner A's control, then this kind of division of the profit could create ill will and lead to problems with the business. Let's look at the third example that's given in the module, and in this case we didn't have profit at all, we had a loss. How is a loss distributed among the partners? Well, the answer is in exactly the same way that profits are. We begin by giving the salary allowance to partner A, and then we allow for interest on the average capital balances, which means we've again distributed $60,000. But we began with a net loss of $10,000, so now our remainder is a negative $70,000. This $70,000 is divided up according to the P&L sharing ratio, and 3/4 is charged to partner A, and 1/4 is charged to partner B. When all the dust settles, we find that partner B's capital account actually increases by $12,500, while partner A's decreases by $22,500. As far as partner B is concerned, it's as if there was actually a profit in the business, and partner A is obviously being charged for much more than the loss that was incurred during the period. This is a continuation of the effect that we saw in the previous example, but it's magnified because of the loss. Partner A is likely to feel that this distribution of the loss is unfair and may well decide to leave the business. If so, the business will probably be disbanded. It's important that the partners understand all the aspects and all the possible ramifications of the P&L sharing arrangement that they agree to in their partnership agreement. This awareness is also obviously very valuable for you to have if you ever find yourself in the position of becoming a partner in a partnership or a member in an LLC.